Hello, I'm Sandy Weaver with Weaver Financial. Let's do the numbers. In a nutshell, bonds had a puny year. U.S. stocks did quite well. Overseas stocks did not. The Federal Reserve wants inflation to return to 2%. It inched back up to 2.7% in the November Consumer Price Index. We get December's data point tomorrow. The Federal Reserve continued cutting rates in November and December, but is widely expected to move slower in 2025 now. At year-end, U.S. large company stocks were up 25%, small companies finished at 12%, while stocks of overseas companies returned only 5%. Yields on bonds have been unexpected and volatile. The bond index returned 1.3% to its investors. The Federal Reserve's actions have so far produced a healthy U.S. economy. We've seen signs of robust growth tempered by some signs it's slowing. In the latest jobs report, wages still grew at 4%. Labor force participation remained 62.5%. Unemployment slid down to 4.1% last month. The number of jobs created was very solid. There are still more job openings than unemployed workers. Inflation is proving to be sticky. The impacts from the change in administration are heavily influencing short-term forecasts, since tariffs have historically spiked inflation. If that comes to fruition, the Fed will likely lean against the wind again to counter it. Most pros have changed expectations to only one or two further interest rate cuts in 2025. We will not get the low rate environment many had predicted earlier. You can see that small companies, which fare better with lower rates, returned far less than large companies in 24. The U.S. economy grew a revised 3% in the third quarter. Good news. The Atlanta Fed's GDP Now tool is estimating 2.7% for fourth quarter. November retail sales were up. In the end, though, it's all about interest rates and corporate earnings. Rates are down a full 1% so far and may get cut a bit further. Corporate earnings for large companies remain above average. Fourth quarter earnings are expected to come in at 12%, 10% overall for 24, and 14 to 15% for 2025. To recap 2024, earnings rose 6% in the first quarter, 13% in the second quarter, and 14% third quarter. A healthier global economy would be welcome, since 42% of revenues of our large U.S. companies come from overseas. Here are some risks ahead. The stock market is priced at 21 times expected earnings, still high. 7 of the large companies in the S&P 500 index made up 57% of that index's 25% gain last year. So that means 493 companies contributed far less. But 2023 was even more lopsided. More companies than usual have issued negative guidance this quarter. That's how much they think they'll earn in 25. Investors will be expecting profits from AI, artificial intelligence, to expand beyond tech to real companies doing real business with you and me. If investors don't see that, some of the hype comes out. Government liquidity could become a problem if Treasury auctions are not well received. We have a lot of debt now. The Fed has given us lots of liquidity too. Politics. The expected better business regulatory environment from the new administration may not overcome the tighter labor if immigration is squeezed and the higher inflation if new tariffs are applied. Most pros expect a year of ups and downs. Hold your seats. Few, almost no pros are expecting a recession, although some are expecting a stock market correction. Europe continues to disappoint. Economic growth is low there. Some pros term it a recession expected to last 3 or 4 years. Europe is an export-driven economy. Tariffs and a slowdown in global trade will not help that. The 2 wars on Europe's doorstep have forced them to change their energy sources and pay more. Their stock market returns were far lower last year. China too remains slow. GDP growth is expected to slow even further. Internal suggestions that they are not growing at their 5% target are dealt with harshly. As expected, they've been taking steps to bypass trade with the U.S., such as building ports in South America and plants in Mexico. We invest little there directly, but many of our U.S. companies operate in and export to China, so we care. Where's the best place to invest money in 2025? We don't know that, but we do know that we're dealing with a fair amount of certainty and some uncertain moves by the big players. We do know we'll get some surprises, like the 10-year Treasury yield backing up while the Fed cuts short rates. We do know that diversifying our investments in different countries, weighting those accordingly, works. We do know that diversifying in the large international companies down to the small U.S. companies works. We do know that diversifying in steady companies paying dividends and in high-flying growth tech companies works. We do know that spreading our bond investments far and wide among a variety of debt works. Historically, we do know those steps get us more of the higher returns and less of the harsh market losses. Thank you for your interest. Please call or email if you want to dig in further. I'm glad to pass on my readings, podcasts, and the other sources.